Hi, it's Marty. Cold day in March, so I'm a little casual dressed because it was freezing this morning. But today's Fed Day. The Fed is widely expected later today to raise rates a quarter point. They're going to raise short-term rates. It's actually the overnight rate that the Fed charges Federal Reserve banks. It has no direct impact on mortgage rates. Mortgage rates adjust based on what's going on in the bond market. The bond market has already priced in that the Fed's going to do this today. It would be much more of a shock if they didn't, or it would be a shock if they said wacky things when they released it that the bond market wasn't expecting. So for you mortgage customers, nothing is going to happen if they raise rates at a quarter today and say what everyone expects them to say. It's only if they would do something unusual like not raise them or change their forward guidance because they see more inflation than showed up, as an example, in today's CPI consumer price report. But the bond market adjusts ahead of time. So rates have already made their move, so don't panic. However, if you have a credit card, a home equity loan, things like that that are based off of prime, those rates will go up and they'll adjust more or less immediately on your next statement or the statement after that accordingly. But the Fed today does not directly control mortgage rates. So all mortgage rates aren't going up a quarter at 1:30, 2:30, 3 o'clock or whatever you see. Actually, the last time they tightened, 2 days later, mortgage rates were about an eighth lower than they were before that because the forward guidance was more dovish, meaning less inflationary than otherwise expected. So the thought was that the market had overshot how far rates were going to go up and reacted back down. So today, don't panic. We'll have more on this in the next couple of days, but the bond market sets mortgage rates, not the Fed.